Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at MongoDB.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis.
When we analyze this company, you have to realize that its whole structure has basically shifted in the last few years.
Right.
This is not just a database company anymore. It's really defined by its cloud offering, Alice.
That's the engine. It's the single primary driver of all their revenue growth. And it's what turned the business into, this high-growth, cloud-centric model.
And that transformation is the entire story here. Atlas is the linchpin.
It is. It lets them capture that huge shift to cloud infrastructure. And we have the proof that this has reached a critical scale.
The inflection point.
Exactly. They hit a major one, surpassing that huge $1 billion mark in annualized revenue. That was back in Q4 of fiscal year 2022.
And hitting that billion-dollar milestone, that signals real market acceptance. Maturity.
It really does. It proves they can scale globally. And what's amazing is just the speed they got there.
Yeah.
At that specific point, Atlas revenue growth was just red hot. It hit an explosive 85% year over year.
85%. Now, of course, when we look at more recent numbers, that growth has, naturally moderated.
Sure.
For instance, in Q1 of fiscal 2024, Atlas revenue growth was around 40%.
And the immediate reaction might be, wait, why the slowdown? But this is where you need context.
Right. Growing a small base is easy.
When you're growing from, say, 100 million, 85% is easier to hit than growing a multi-billion-dollar base at that same rate. 40% on that much larger base is still exceptionally strong.
Shows the demand is still there. Robust.
And the momentum metrics actually reinforce that. It's a healthy moderation, not an alarming one.
Because that 40% growth was accompanied by the company achieving, and this is a quote, the most net new customer additions in over 2 years.
Think about that. So even as the percentage slows down, which is just the law of large numbers, the actual volume of customers coming onto the platform is accelerating.
It tells you the product market fit is still getting wider. New customers are finding them essential.
At an accelerating pace, too. That's the definition of momentum.
And if you zoom out a bit to the overall financial health of the business, this is exactly the model investors love to see in a premium cloud stock.
It's a pure high-margin SaaS model, and crucially, it's capital light.
What do you mean by that?
Well, they aren't spending billions building out their own data centers. They're running on top of AWS, Google, and Azure infrastructure.
Which has huge implications, especially now with interest rates being higher.
Absolutely. Because they aren't weighed down by huge infrastructure costs or debt, they just operate as a cash-generative machine.
And that insulation, that's what allows them to reinvest so aggressively into R&D without having to, constantly go to the debt markets.
Or dilute shareholders. It's a huge advantage. They can basically just fund their own growth.
Okay, so the financial foundation is solid, but the long-term success of any database company really comes down to its competitive moat.
And here, the moat is it's fundamentally different from legacy players. It's all about developer mindshare.
Right, let's unpack this moat because it's like a flywheel effect, isn't it? It's fueled by just the sheer enthusiasm of software developers.
The scale is staggering. I mean, we're talking about over 90 million downloads of their community platform.
90 million.
And a massive 1.5 million users on the free Atlas tier.
That free tier is just a brilliant strategy. It's a low-friction on-ramp.
A developer uses it for a personal project. They get good at it. They love how easy it is.
And then they go to their corporate job and become the internal champion for it.
Exactly. It creates this powerful bottom-up sales motion. The employees are doing the selling for them, which just crushes their customer acquisition costs.
And it's not just because it's free. It's really driven by what they call their architectural superiority.
Yes, the Nexus architecture. It's built around a document-based data model.
And if you, the listener, only remember one thing about why they're so disruptive, it's that phrase, document-based.
Right, because traditional databases, the old guard, they use rigid tables. Rows and columns, like a very, very structured spreadsheet.
Which makes it really hard to handle the kind of fluid, messy data that modern apps, and especially AI, need.
The document model is just inherently more flexible. It means developers can build and ship new features much, much faster. It's the best of both world reliability and flexibility.
And this flexibility, it translates directly into performance. You can see it in the benchmarks.
The Temenos benchmark specifically, it's a big one for the finance industry.
What did it show?
Atlas processed over 150,000 banking transactions per second, so it can handle high-scale, mission-critical workloads.
But here's the kicker. This is the bit that gets a chief technology officer really excited.
Go on.
That same benchmark showed Atlas delivered twice the performance, while using less than half the resources compared to old-school relational databases.
To an enterprise customer, that's a game changer. Better speed, better reliability, and your cloud bill is significantly lower.
In this economy, where everyone is scrutinizing their IT spend, that efficiency is just a massive selling point.
And there's another strategic advantage. Their architecture helps them sidestep one of the biggest risks in the cloud world, vendor lock-in.
Because Atlas is uniquely multi-cloud.
Yes. You can run your data anywhere you want. AWS, Google Cloud, Azure, you have the choice.
Which is a huge differentiator. If you commit to, say, AWS's own database, you're basically stuck on that platform forever.
MongoDB gives customers freedom, leverage really, when they negotiate their cloud contracts.
But here's the really insightful part. The multi-cloud strategy isn't just defensive. It's actually adding to their revenue.
How so?
Through partnerships. They saw over 80% growth in deals that were sourced by those same cloud vendors.
So wait, the people they're competing with are also their biggest sales channel?
It's the classic co-opetition model. And that 80% growth tells you it is working incredibly well.
Right, because AWS and Google benefit when their customers use Atlas. It drives huge infrastructure consumption on their platforms. The partnership is a win-win.
Okay, so financials are strong, the moat is deep. We need to focus on the forward catalysts. What's going to sustain this momentum?
Well, management is very bullish. They're confidently talking about a market opportunity that's over $70 billion.
And that's not just new stuff. That's ripping out all the old, obsolete legacy systems.
But the biggest, most immediate catalyst is, without a doubt, the massive secular tailwind from AI adoption.
Okay, this is the narrative every investor needs to be watching.
It is. The company has explicitly positioned itself as, quote, a central pillar of the emerging AI tech stack.
They're telling the market directly, we are going to benefit from the next wave of AI applications.
And their architecture actually supports this claim. Why? Because these large language models, they feed on unstructured and semi-structured data.
The exact kind of data the document model was built to handle.
Exactly. As companies rush to integrate AI, they need a database that speaks the language of AI. MongoDB does.
And we're seeing proof of this in their customer base. They're moving from just being a developer tool to a full-on enterprise platform.
The evidence is in the growth of their 6- and 7-figure customers.
These aren't just small pilot projects. We're talking multi-million-dollar deals. That's a sign of enterprise standardization.
Which solidifies their revenue for the long term. So everyone should be marking their calendars. The Q4 fiscal 2025 earnings report, that's probably late January or early February 2025. That's going to be a big one.
And the market won't just be looking at growth rates. They're going to want proof points. Proof that they are that central pillar for AI.
So you should be watching the big cloud vendor summits for specific product announcements.
What are we expecting?
New AI functionality, things like advanced vector search capabilities or new frameworks for integrating with LLMs.
Vector search is key. It lets the database understand context and similarity, which is essential for smart AI-powered search.
These are the features that will cement their status as foundational AI infrastructure.
But we can't let all this AI excitement blind us to the risks.
Never. No growth story is without headwinds.
So the biggest bear case, it focuses on competitive pressure from those exact same hyperscalers we just praised.
Right. AWS DynamoDB, Azure Cosmos DB, these are native, often cheaper, competing solutions.
And the risk is that if, say, AWS decides to aggressively push its own database, growth could slow down.
It's a real risk. But the mitigation they point to is that robust partnership model we talked about.
The 80% growth figure.
Yeah, it suggests the co-opetition is working in their favor. The benefit AWS gets from a customer using tons of their infrastructure for Atlas often outweighs trying to force them onto a proprietary solution.
Okay, what's risk number 2?
Valuation compression. This is common across any high-growth SaaS business. If the whole software sector sees its multiples shrink because of macro factors,
Like rising interest rates or a recession.
the stock could face headwinds no matter how well the company itself is doing.
So the counter-argument there is that they deserve a premium multiple.
And why is that?
Because of that strategic pivot to being enterprise critical and their direct link to the AI narrative. They shouldn't be compared to just any old software company.
Their structural infrastructure. As long as they keep proving they are fundamental to both cloud migration and AI, they can justify that higher valuation.
So to synthesize all this,
Mhm.
the investment thesis here seems structurally very sound.
It's a multi-year growth story. We're talking a 12 to 36-month horizon. It's driven by replacing old systems.
And powered by those two massive forces.
Yeah.
Developer mindshare and their position in AI infrastructure.
So investors should definitely look to accumulate on pullbacks. Use the earnings reports and product announcements as your key markers. This company is building a deep, defensible moat.
So the key question for next quarter isn't just if they can sustain that 40% growth, but exactly how much new, tangible AI functionality they unveil to solidify that central pillar claim and prove they are the unavoidable database choice for the AI era.
Make sure you subscribe to Smart Wealth with Joshua so you don't miss our breakdown of that next earnings report.